Hi everyone, welcome back to my channel. In today's video, I will be sharing with you my personal tried and true money practices and principles. This was a highly requested video, especially after following my recent videos talking about my journey in trying to find more balance with my spending. So if you've been on my channel before and you've been around a while, you may already know that I am super passionate about financial freedom and independence and also financial empowerment. And I get very excited about topics around saving and investing. In fact, I know it's sort of corny, but I do get more excited about saving and investing than I do actually about shopping. This is true, and it has been for many, many years since I was a young adult. So I can go on and on and on for many hours on this topic, but I'm going to try really hard to keep this video as concise and tidy as possible so that you get all the most important nuggets out of this video. I do have a cup of tea here. If you want to pause, grab yourself a drink, a snack, or maybe even a pen and paper, perhaps a calculator in case we start doing calculations. Get everything you need and let's get started. So this is going to be somewhat of a podcast style, meaning there's not going to be a lot of eye candy here to look at, but hopefully you can tune into my voice. The very first money practice that I want to share with you is one that I've shared previously in other videos, and that is the concept of PYF. Pay yourself first. I have mentioned this before, and a lot of you commented saying that this is a really interesting concept and that you are also going to try it. This is something that I have been practicing since I was in my early 20s, since I got my very first full-time job at the age of 22. So for 2 decades now, I have been practicing the PYF principle. And I don't know if this is an official kind of term, but that's what I call it, paying yourself first. What this means is basically that you take your hard-earned money, your paycheck, your income, and you immediately, right out the gate, allocate a portion of it to go into a separate account that is for you, for your future, okay? So for example, I get my paycheck from my company, and automatically on a set date every month, a specific percentage goes right out to a separate account. This is me paying myself first. This is my hard-earned money, so we want to prioritize ourselves. Other than taxes, which is required by law, the next order of priority is us. Then what you have left over with is what you pay your bills, your recurring expenses, and your non-essential luxury items, okay? I am not referring to those who are living paycheck to paycheck. I know that there is a stark reality out there that some people are struggling at the moment, and they don't have the economic means to put anything away, let alone, survive to get their bare essentials. But I'm going to assume that for the purposes of this video, most of you or all of you who are watching my channel do have some buffer and do have some discretionary income or discretionary spending that you're doing that you could perhaps pull back a little bit to pay yourself first. Okay, so that's principle number 1. And what's really important to note in terms of that is you want to set aside a set percentage, not a fixed dollar amount. And the reason being is because let's say you say I'm gonna set aside $100 a month. Okay, that's a good starting point, right? But then maybe your income grows, or hopefully it does, right? You want your income to continue to rise. So as your income goes up, your savings is going to stay flat if you have a fixed dollar amount set, which means that you may look back in 10 years and go, how come my savings is so low proportionate to how much I'm earning? So instead of setting a fixed amount, what I encourage is for you to set a fixed percentage. And you can adjust as you go along. But for example, ever since I was younger, I wanted to put aside at least 30%, and then I would adjust over the years. So that means that as my income grew, so did my savings proportionally because it's a percentage. Does that make sense? So that's definitely one of the tips I want to share with you. Tip number 2. The second money practice that I want to share with you is to claim your free money. Yes, there is free money out there to be claimed, and it would be shameful if you didn't at least explore your options. So this portion of the video is going to be more US specific, so this is for my fellow Americans, but I would imagine that whether you're in Europe or Canada or Asia or other parts of the world, there will be similar types of vehicles, and I'm hoping that the overarching principles will still be relevant. So here is just a quick chart. If you want to screenshot it, feel free to do that. This shows some of the most common common, most popular tax savings vehicles available to us in the US. Just very quickly here, the 401k is a company-sponsored retirement plan for for-profit businesses, and then the 403b is the equivalent for nonprofit businesses or organizations, meaning that if you are an employee of a company and they offer something like this, you can contribute upwards of $20,500 this year. That's the 2022 contribution limit. You can essentially sock away over $20K this year, and that would reduce your taxable income. So you're getting taxed on less money. So at the end of the day, you're actually keeping more money, which is free money. That's how I see it. Additionally, for the 401k, if your organization has a matching program, then that's additional free money. So as an example, some companies will do a dollar for dollar match, let's say up to the first 10% of your contribution. That means that if you put in $1,000 a month, they put in an additional $1,000 a month. So now it's $2,000 and you have more money to invest with, okay? Other companies might do 50 cents to the dollar. So you put in $1,000 a month and they add 500. So now it's $1,500 a month to invest with, okay? So definitely look into your options. Then you've got the IRAs. These are some of the most common ones, the Roth, the traditional, and the SEP, which is very specific to self-employed professionals. But I know that nowadays in this generation, there are many, many more young self-employed individuals, especially with vlogging and YouTubing and freelancing. So this is definitely an option to look at if you don't have a company-backed or company-sponsored program. This year, you can sock away $61,000. That's your maximum. So there's generous room there to put away money for your future and your retirement. Oh, by the way, these here just show the numbers for those who are over the age of 50. There's a little bit more room to contribute. If you're over the age of 50, they are called catch-up contributions. They're allowing you to catch up because the government recognizes that you are probably closer to your retirement age. So for example, for the 401k, most of us are going to be able to sock away $20,500, but if you're over 50, you can sock away as much as $27,000. And then for the IRAs here, the Roth and the traditional, you can sock away $1,000 more than the rest of us, okay? 529 plans are for my fellow parents out there. You guys know my husband and I, we have 2 children. We are expecting them to go to university. I have a master's degree. My husband has a law degree, so they may even go on to additional education. And so this is really smart for parents who want to plan for that. This money is used for college and higher education. So you put the money in, it's actually after tax dollars, but the earnings grow tax-free. And the withdrawals that you eventually make are also tax-free if you apply them towards education expenses. So this is a beautiful thing. And there is officially no limit to how much you can put in. And also grandparents and aunts and uncles, if you have anyone in your life that has the means and is generous enough, then you can also have them add in money for your child. We don't have anyone like that in our family, so it's just my husband and I socking away. I think we started contributing to our kids' 529 plans since they were about 2 or 3 years old, so we're in decent shape now. Then you've got the health savings account. That is specific to those of you who opt for the high deductible insurance plans through your companies. That's what I have here, and we're signed up for an HSA for the family, which means we can sock away $7,300 this year. On a personal note, my husband actually had a recent injury playing soccer, and the injury turned out to be a bit worse than we expected, and he wound up getting surgery actually this week. And we were given the heads up that even with insurance coverage, the out-of-pocket cost for the surgery would be in the several thousands range, but we are okay, not really batting an eye, because based on our HSA balance, we know that we have more than enough to cover it, especially because we enrolled last year as well, and whatever money that was not used, it rolls over, so your balance is probably going to grow over the years. This also is an account that will allow you to invest, for example, in the stock market, and again, has the tax savings benefits. Then down here really quickly are the flex spending accounts. I'm sure many of you are familiar with these. I do want to make a note here that for the flex spending accounts, the unusual thing about them is that they have a use it or lose it quality. So I want you to be careful if you've never contributed to any of these before and you want to experiment this year or next year. Use it or lose it means if you have a balance left over at the end of the calendar year on December 31st, then you you basically lose that money. So for example, this is the transit flex spending account for those of you who have transit or commuting transportation costs related to work. This year you can sock away $2,850. That does reduce your taxes as well. I do not max this out. For everything else, I do max out except for this because I know that my commuting costs are not going to be that high. I don't commute very often. I work from home. And when I do, I just need a Metro card and it's a fraction of this. So I might put away just a small portion of this amount. I don't want to have money left over and then be forced to buy like 10 Metro cards by the end of the year so that I don't lose the money. The same goes for the childcare FSA. If you don't use the money for, let's say, daycare or summer camp, and for whatever reason you have $3,000 left over at the end of the year, you will lose that money. So I would say underestimate how much you want to contribute to these type of FSAs. If it is your first time, test it out, see if you do manage to use it all up, and if you do, then you can adjust the numbers the following year. Same thing with the health FSA. So I know that was kind of a lot, but I hope that it was helpful. It's a really quick breakdown. You can obviously do your own independent research and study to find out more. Okay, money practice number 3 is to secure your peace of mind. Yes, to a certain extent, money can buy peace of mind. Of course, we can't control everything that goes on in the world, and there will always be some unexpected situations that arise from time to time. But if you have excess income that you can put aside in an emergency fund that is highly liquid and highly accessible, you're essentially securing your peace of mind so you can lower your anxiety level in the event that something happens and you need extra money. So in our case, we put aside a certain amount of our money into a low interest bearing savings account, and it is really meager, measly, pitiful interest rate, well below 1% right now. So from a mathematical financial standpoint, it's not a very wise investment. I don't consider it an investment. It is purely to secure some additional savings to have that peace of mind that I mentioned. So we have at least 1 year of living expenses in that account, and because it's just a plain old low interest savings account, I can easily access it for emergencies. It is highly liquid. There are no rules, there are no restrictions. For example, when we talk about these wonderful tax savings vehicles, unfortunately, that also comes with rules. So if you take the money out at the wrong time or for the wrong reason, there may be penalties and tax implications. But if you're parking some money in an emergency fund in a plain Jane savings account, then yeah, you're not earning much and you're probably losing out some money to inflation, but you have that peace of mind that you have access to this money. Again, for us, it's at least 1 year of living expenses. I believe that in the finance world, the rule of thumb is 3 to 6 months of living expenses put aside in an emergency fund. If you want to be more aggressive, you can go higher than that. For me personally, because I'm very conservative and because we have a family to support, I feel that minimum 1 year of living expenses is what will secure my peace of mind, but everyone has their own threshold and it's a very personal decision. So that is for you to decide, but I highly recommend that you have some form of a highly liquid, highly accessible emergency fund set aside that is not related to your future retirement, college savings. This is purely emergency. Okay, hopefully you're still with me. We're now more than halfway through. We're on to money practice number 4, and that is to invest. Saving is not the same thing as investing. Like I just said, I put a certain amount of money in our emergency fund in a very low interest bearing account. That is purely for peace of mind. That is saving. But investing is where the bulk of our money goes, and that could be in the stock market, that could be in real estate. For those of you nowadays who are really into crypto, that's another vehicle. But investing is very important because I believe that if you leave your money somewhere under your mattress, in a tin box, in a low interest bearing savings account for too long, you are basically losing money because inflation is real. There is inflation, meaning the value of your money continues to go down if you don't invest it. And right now, economists are saying we may be heading into a hyperinflation market. And if that is truly the case, you need your money to keep up by growing it, okay? So I don't want to harp on this too much. I'm not a finance professional. I do not work in the finance industry. I know many of you thought that I did. I do not. This may be a good time for me to just put out a full-on disclaimer. Please do your own research, do your own independent independent study. A lot of this for me is just self-taught because I had such a passion for this area. I learned a lot from my dad growing up. My husband and I talk about this stuff a lot. He wrote a book on this topic. I know many of you purchased it, but please do your own independent research, do your own due diligence, and especially when it comes to investing, make sure that you understand your risk tolerance, how conservative, what your time horizon is, when you might think you need the money, and if you do need to consult a certified financial planner or analyst, then please, I encourage you to go ahead and do so. Okay, moving on. Money practice number 5 is to give. Yes, to give some of your money and your resources away because it's good for us. It is good for our well-being. It's good for the community and the world at large. There are so many studies out there that show when you give your money away or donate your money to charitable organizations and to causes that you believe in, you feel much happier, you feel more pleasure in your life, and you feel more connected with the world. So there are all kinds of health benefits, and I believe it's good for your heart. I believe that it's good for your heart and soul, not to hoard things and not to hoard money. You want to stay away from the risk of making money your central point of focus, because otherwise it could make you very sort of greedy. It could make you selfish. It could make you tunnel vision. It could also make you incredibly anxious and create a false sense of security, right? So I believe giving it away is a way to stay balanced as much as possible. There are also financial benefits for the large charitable organizations that you donate to at the end of the year. They will send you a tax statement and you can use that for tax deductions. So there could be a financial benefit. And also, if you are looking to gift money to loved ones, family members, this year the IRS allows upwards of $16,000 per recipient, and they do not have to pay taxes on what they receive. Meaning if you give $16K to your mom, $16K to your dad, $16K to a sibling, they do not have to pay taxes on what they've received from you. So I hope that this is helpful information for any of you who are trying to incorporate giving into your money strategies and money approach. Money practice number 6 is simply to automate. Automate how your money goes out and where it goes every month so that you remove the hassle of having to remember, and you remove the idea that any of this is a chore. It should be easy. It should not be difficult. So for example, if you're participating in these retirement accounts, whether it be 401k or IRAs, then you are automatically having a certain amount of money go out into those accounts every month or every year, okay? It's sort of like a no-brainer. In fact, the same goes for giving. My husband and I, we actually automate how much goes to some of our charitable organizations that we have been supporting, because that core group we know we will continue to support. So every month, a certain amount goes to those individuals or organizations, and anything else that might pop up, special causes, special needs, emergencies from family and loved ones where they need support, then we will do that on the side. But like I said, if you have a core group of charitable organizations or causes that you consistently support, you may even want to consider automating that as well, because it just makes life easier and there's less to manage if you automate. Okay, we're almost finished. We're on money practice number 7, which is the last one. I'm also almost out of tea, so this is good timing. The last point I want to make is to track your money. Track your spending. This should be fairly easy for most of us because a lot of us nowadays are using credit cards for the vast majority of our purchases. Personally, I probably put 99% of our spending on credit cards, and then we pay it off at the end of the month. It's just easy to keep track that way, and at the end of the year, you get a statement telling you how much you spent in each category. So you might get a pie chart that tells you X% went to travel, X% went to dining, X% went to entertainment, and so on. I have noticed in my case that some of the expenses were allocated to the wrong categories, probably because the bank doesn't know what the expenses were for, but generally speaking, it's a good picture that you're getting. It's a decent idea of how your spending has been the past year. And if you like where your money has been going, then you can stay on track the following year. If you don't like where some of your spending has been, then you can start to make adjustments to your spending habits, and hopefully it looks different next year. In a recent video, I shared that I compared my 2020 spending versus my 2021 spending. And this was specific to my discretionary luxury goods shopping, okay? And I was shocked by how much of an increase there was between those 2 years. And so this year in 2022, I am redirecting and reprioritizing. So I think that that kind of summarizes where I am today and where I want to take my money in 2022. I hope that this video will be helpful for you as well as you incorporate some of these strategies to get a better handle on where you want your money to go for this year as well. So I mentioned shopping for luxury and fashion. That is my kryptonite. I think we all have some kind of kryptonite that makes us weak in the knees. Some people, it's handbags, jewelry, shoes. Some people, it's stamp collecting, it's lamps, it's furniture, home decor. Some people, it's cars. Whatever your kryptonite is, I would recommend that you also track separately your spending in that specific category. That is what I've been doing, and that is what allowed me to compare my 2020 spending versus my 2021 spending in that specific category. So something new that I'm doing this year that I mentioned recently is that I'm also tracking separately the money that I'm saving by not making impulse purchases. So I know we're only into January, but believe it or not, I've already had about a handful of temptations, and there were moments where I put items in cart, I added them to cart, I was about to purchase, but I decided to pull away, resist, or just sleep on it, and then I changed my mind the next day. So there are a handful of items already on my new tracker, and what I do is I put the item and I also put the price. So I'm tallying it up, and I would imagine by the end of 2022, I'm going to have a decent list with a decent total balance that I saved myself by not purchasing these sort of non-essential items. I might even take that total balance and transfer it. I might take that money and transfer it into a savings account just as an extra motivator so I can continue this on my journey, but we will see. I may also share that tally, that spreadsheet at the end of 2022 if anyone is interested. I know that many of you, when I mentioned this recently, said that you were going to join in and that you were also going to create your own spreadsheet and track the items that you weren't buying and the amount of money you were saving. So that would be really cool. If you're doing that, let me know in the comments below and share that with me. But I hope that this video was clear and informative and valuable to all of you who requested this video. If you have specific questions, please let me know in the comments below. I'll try my best to get to them. And I am happy to elaborate further on any of the concept that I mentioned here, but I just want to make sure there's enough interest. For example, if I receive at least 1,000 likes on this video, then I'll know that I can continue this as a series and there will be enough interest from all of you in my audience. Otherwise, I'll be sprinkling it in here and there as usual. Thanks so much for watching. I'll see you all next time. Bye-bye.